So a doctor comes to me and says, "Hey, Austin, I'm looking at buying a $1.3 million property and I need help getting a mortgage. I'm looking for the cheapest interest rate." And by this time, he's already shopped it around 3 different lenders and a few other mortgage brokers. And so I asked him, "Look, I totally understand why you're looking for the cheapest interest rate, but just to clarify, are you looking to pay the least amount of interest?" And he says, "Well, of course, that's why I'm looking for the cheapest interest rate." Okay, perfect. Those aren't necessarily the same thing, but may I ask why you're looking at paying the least amount of interest? And he said, "Well, number one, no one likes paying interest, obviously. And number two, I just want this mortgage gone as quickly as possible." So then I say, okay, perfect. We are on the same page here, but 10 or 15 basis points isn't going to get you towards that goal. There's a better way to structure your mortgage, especially because you're in the highest tax bracket. 15 basis points is nothing compared to paying 40, 50% of your income in taxes. And so what I'm going to show you here is what I showed this doctor that allowed him to save over $600,000 over the duration of his mortgage. So just as a quick side note, whenever I speak about rental properties, this is from my own experience. I'm not just explaining theory. I've actually invested in Ontario real estate and I still own rental properties. You can see these Toronto Life articles on me, UFT articles. I've been featured on numerous podcasts as well. I've owned over 25 rental properties in Ontario, over 40 rental units. So whenever I speak about these concepts, again, they're based on my personal experience.
Before we get started, here's a quick disclaimer. This content is for general informational purposes only, and it's not financial, tax, or legal advice. While I am a licensed mortgage agent, I'm not your mortgage agent, and nothing here creates a client relationship. Everyone's situation is different, so please qualify and consult a professional before making any decision. If you'd like to talk through your specific scenario, book a call and I'll help connect you with the right professionals.
Back to the client. Okay, so over here, I have a spreadsheet of some of the clients' rental information. They currently have a property that they're living in, and I asked them if they're looking at keeping this or they're looking at selling it. They said that they wanted to keep it and hold it for long-term wealth. So then our next analysis is to see, okay, is this property even going to be cash flow positive in today's environment? So let's take a look into the rental number. So we can see the rental income is going to be about $3,300. We looked online and this is what their realtor told us. These are some estimated expenses. I just rounded it up for this specific example, but condo fees were $712. Property taxes are $3,100 a year, which is $258 a month. Mortgage payments are $1,850. Insurance is $60. These next expenses, vacancy and repairs, they don't happen every single month, but when they do happen, it's going to cost you money. So you want to make sure that you budget for it. So I put 3% for vacancy of the gross rental income. So $99 a month, and repairs, I used 5%. So that's about $165. So their total expenses are $3,144. And so the cash flow before taxes, because remember, there's always tax implication on these things, is going to be $155.67 a month, right? So it's good that they're in a cash flow positive position. Of course, after tax, it's likely that they will probably be negative because you cannot write off principal pay down, meaning you can't write off 100% of the mortgage payment. Anyway, so we go through all of this, we loop in their accountant, and they decide, you know what, I want to continue to hold this property even after running through this analysis. So what is the strategy that you're talking about, Austin? How could I potentially save hundreds of thousands of dollars having a rental property? Well, the strategy is called cash damming. So as you can see on this slide here, most people will collect rental income and then use it to pay off the rental expenses. And they're either cash flow positive or negative. Now, there's nothing wrong with doing this, but it's not an efficient way to build wealth. It's not an efficient way to pay down your primary residence as quickly as possible. Instead, what we want to do is we want to restructure the cash flow. So the rental income continues to go in the rental account. There's no rule that says this rental income has to pay off rental expenses. Instead, what we're going to do is we're going to apply a prepayment on their primary residence. So their primary home, we're going to take the rental income and pay down the mortgage. Okay, we're going to pay it down by the 3.3K. So this mortgage is not tax deductible, meaning that if you have a primary residence, you actually cannot write off the interest on the debt, right? So it's not efficient. That means you're using gross income, paying taxes to the government, and whatever's remaining is being used to pay down your mortgage. So this is not tax deductible. So what we're going to do is we're going to take the rental income, we're going to pay down this mortgage directly and reduce the bad debt. Bad debt meaning non-tax deductible debt. If you have a re-advanceable mortgage, what ends up happening is that your home equity line of credit gets bigger and bigger and bigger. So if you have the right mortgage structure, any sort of principal pay down will allow you to re-borrow it in a HELOC. So we're going to pay down the mortgage by the rent, and then we're going to re-borrow the rental expenses from the primary residence HELOC. Okay. Then we're going to use that to pay off the rental expenses. Now, what ends up happening is that this home equity line of credit becomes tax deductible. You're actually able to write off the interest on this HELOC. So when we write it off, we get a tax refund. And when we get the tax refund, we can use that tax refund to then pay down the mortgage even quicker, right? This bad non-tax deductible debt. So what we're ending up doing is converting this non-tax deductible debt into good debt, which is tax deductible. And we're going to accelerate the pace of this debt conversion so that the only debt remaining is good debt. And then we're going to focus on paying down that good debt. This may sound confusing at first, but let's go through the numbers. Okay, so I plugged in the client's numbers. They are at a 53.5% marginal tax bracket, which is the highest one in Ontario. So saving every dollar from a tax perspective is way more meaningful than 5, 10, 15 basis points on a mortgage. Over here, you can see this green line is a standard mortgage. It's going to take 30 years to pay off, right? And over those 30 years, they're going to spend a lot of money on interest. About, if you can see over here, $738,000 on interest on this $1.3 million property that they're buying with 20% down. So the goal of this is to convert this into a tax deductible mortgage because none of this is tax efficient. How we do this is we run the rental income through the primary residence, right? So as we can see here, the primary residence mortgage, the non-tax deductible debt, is being paid down at a quicker pace. So by year 13, or I guess exactly 12.3 years, this client has no more bad debt, meaning that their mortgage amount is at $0 because they are taking the rent and force paying down the mortgage, getting tax refunds, and also paying down the mortgage. But this does not mean that they don't have any mortgage left. They actually do have debt, but now it's the home equity line of credit, as you can see on this purple line. So you're seeing that this blue line is the mortgage. It's being paid down, but it's being converted into the home equity line of credit, which is the HELOC, which is getting higher and higher. And remember, this HELOC is actually tax deductible, which means that they're getting tax refunds on this. So at year 12.3, there's no more mortgage. It gets fully converted into the HELOC. So now we have the HELOC remaining. And I know what you may be asking. This client said, hey, Austin, this sounds wonderful and great, but the HELOC interest rate is actually higher than my mortgage interest rate. So let's say that their mortgage rate is 3.99%, okay? And then the HELOC rate is 4.95%. So they're going to say, hey, Austin, why would I convert it over to a HELOC? Well, remember, you're able to write the interest on this HELOC off. So the marginal tax rate is 53.5%. So how this works is, think about you going to the grocery store and you're buying a loaf of bread for $10. And then you have a coupon that says you're going to get $5 back once you buy the bread. But you won't get that $5 back until next year. So you go in the grocery store, you buy the piece of bread, you give them $10, you file the coupon, next year comes around, and then you get $5 back from the manufacturer. Although you paid $10 up front, effectively, you've only paid $5 for the bread. The same principle aligns here. So you're going to be paying 4.95% on the HELOC, but when you write off all of this interest, the government is going to give you 53.5% of that back, right? So your effective after-tax interest rate, after you get the refund, after-tax interest rate is going to be 4.95% multiplied by 1 minus your marginal tax rate. So your after-tax interest rate is 2.3%, extremely low, significantly lower than your mortgage. And when you get these tax refunds, you continue to use it to pay down your bad non-tax deductible debt. Now, the other question I get is, hey, Austin, this makes a lot of sense. Fantastic. But what if my HELOC goes up? Let's stress test it. Let's say your HELOC goes up 8 times. There's 8 rate hikes, which, again, if there's 8 rate hikes, it's a massive disaster. The last thing you're going to be worried about is your interest rate, because property values are probably going to be down. There's going to be stress in the economy. That's neither here or there, though. So 4.95% plus 8 rate hikes each rate hike is 25 basis points. Okay. So they're going to end up at 6.95%. The marginal tax bracket is the same. Their after-tax interest rate is 3.23%. This is still lower than their mortgage, okay? So even after 8 rate hikes, this is still more tax efficient. But then I challenge them. I say, okay, let's say that you want to stress test. Let's say that there's 8 rate hikes. When you renew your mortgage, right, your fixed mortgage here, what do you think this rate's going to be? You think it's still going to be 3.99%? Because it definitely won't. If you're saying that there's 8 rate hikes and your HELOC is 6.95%, you're probably going to renew your mortgage here at 5.99%, right? So at this 5.99%, this is not tax deductible as well. But your HELOC is tax deductible. So actually the spread, so if I take your non-tax deductible debt minus, if you're tax efficient debt, the spread is 2.76%. In a low interest rate environment, the spread's only 1.69%. So actually, if you think that rates are going to go up, that's going to work in your favor because your non-tax deductible debt will eventually go up, but this is all tax deductible, right? So you're going to be saving even more money in a higher rate environment, which is incredible. So it acts as a bigger hedge, okay? So now that they understand this concept here, they go back and say, okay, Austin, perfect. That makes sense. How do we get rid of this deductible debt? As you can see here in year 12.5, we have the HELOC remaining, but there's no more mortgage, right? If there's no more mortgage, that means there's no mortgage payments. So you're going to continue to make mortgage payments in year 12, except the mortgage payments are going to reduce the HELOC. What else do we know about the HELOC? We know that it is tax deductible, and so you still get tax refunds. So that's those tax refunds that you get because there's no more mortgage. We're using it to pay down the HELOC, right? So the HELOC, everything gets directed to reducing it. The good debt is going to go down exponentially. So what ends up happening is that in year 25, or actually exactly, you can see the debt freedom date is 24.7. Let's round it off to 25 years. In 25 years, you're going to have no more HELOC. You're going to have no more debt, okay? So this orange line is your total debt between your non-tax deductible debt and your HELOC tax deductible debt, right? That forms the orange line. So back to the regular mortgage, it's going to take you 30 years to pay it off, but now your total debt can be paid off in just under 25 years by doing the cash damming strategy. And again, in a higher rate environment, even more favorable for you. So what does that look like numbers wise? Well, first and foremost, this client is going to get $214,000 in tax refunds over the course of doing this strategy. Phenomenal. They're going to be saving $52,000 in interest because they're more tax efficient during the entire process. Also, they're going to be saving $314,000 in payments. What that means is that if you're able to pay off your mortgage in 24.7 years, that is 64 mortgage payments you don't need to make because your loan got paid off earlier. If your mortgage payment is $4,900, as we can see on here, that is equal to $314,000 in mortgage payments that you don't need to make. Now, let me ask you, Mr. Doctor, if you're saving $314,000 in mortgage payments, how much money would you need to earn in your full-time job to pay this $314,000? Well, at a 53.5% marginal tax bracket, they would need to earn almost $675,000 in their full-time job to pay $314,000 in mortgage, right? So we don't even assume that, which means that the benefits are even higher than what's stated here, okay? So the total strategy improvement by doing this strategy is $616,000. So this is a massive saving. And again, Mr. Doctor, 10 or 15 basis points is not going to get you this amount of savings. And Mr. Doctor, what does it mean to you to be able to pay off your mortgage over 5 years earlier than projected? It means a lot, right? You save a lot of money, you end up paying your mortgage earlier, and so you can potentially retire from your job 5 years earlier. After I presented this to the client, they were able to see not only were they able to pay off the mortgage quicker, they were able to create a tax efficient structure continue to hold their rental property and be able to negate the risk of future rate hikes, because even with the higher rate, you get more benefit from doing a strategy like this. So we're currently implementing this for this doctor client, and they could not be more thrilled with the results so far. So the client gets very excited and says, okay, Austin, I want to move forward. I want to implement this thing. But listen up. This thing only works if, one, it's implemented correctly, because implementation depends and differs from lender to lender. It doesn't even work with some lenders. And also, you need to ensure that the tracing is super clean, separate account, nothing commingled. Every dollar is documented. Everything is done correctly. Because if you get audited or you do a sloppy job and the CRA comes knocking at the door, it's possible that they say, hey, this whole thing doesn't work. We're not going to allow it because your documenting is all over the place. This strategy, although it's completely legal, the implementation is a total separate beast. So we decided, okay, we're going to go forward with this. Let's create an implementation plan. And as we're implementing it, we're making tweaks along the way. This strategy is only as good as the person operating or implementing it. So if you're working with someone in the bank or another mortgage agent who has no idea what this is, or they cannot walk you through how to actually implement it or run the numbers for you, I'd be happy to show you how this could potentially work out for you. Feel free to book a free strategy call with me. You can access it down in the comments below or down in the description below, and I'll be happy to walk you through your numbers to see if this could be a right fit. And if you enjoyed this video, I'd really appreciate if you can share this with a family or a friend who you think could get value out of it as well. So if you make good money, you already have a rental property, and you want to see if this works for you, feel free to book a free audit call with me down in the link in the descriptions, and I'll be happy to walk you through your numbers to see if this could be the right fit. And worst case, if you have the right structure or you are already well optimized, you can sleep well at night knowing that you're doing everything correct for your mortgage. And also make sure to subscribe, because I'm going to be putting out more case studies like this, answering your question and showing you different cool strategies on how you can pay off your mortgage quicker and give less interest to the banks.